Hello everyone, welcome to my channel Eco Mystery. Hope everyone is fine and safe. So as we know that in the previous class we have discussed about the depreciation, like what is depreciation, what is residual value, and what are all the methods that we have through we can calculate the depreciation, right? But let's think about if what happens if we sell our asset. So what is the impact of that sale on the depreciation in that particular transaction, how we need to calculate the depreciation. Suppose if you purchase a machinery 5 years ago around 10 lakhs, right, and that time you have determined that the useful life of that asset will be 10 years, and after 5 years you want to sell that asset. You have decided that you no longer need that asset, so you want to sell that asset, right? So how do you calculate the depreciation that time, and how do you calculate the profit or loss on the sale of that particular asset? Okay, so in the today's class we will understand what is the impact of the sale on the depreciation. Okay, so first of all, whenever you want to sell the asset, you always need to calculate the depreciation, or you need to consider the impact of the depreciation till the time of that sale. It means, uh, in the earlier example, if we purchase the machinery 5 years ago and after 5 years we want to sell that asset, so we always need to calculate the depreciation or consider the impact of the depreciation at the end of the 5 year only, so that we can calculate the book value, and through that use of the book value we are able to determine how much profit or how much loss we have. And okay, so let's understand with the basic example, then we can understand what are the journal entries that we need to pass in the particular transaction. Okay, and for the sale we have two options. Either we have decided to sell the asset at the end of the useful life, or either before the useful life. Suppose if you purchase a machinery and that time you have considered that useful life will be 5 years, you have two options. Either you can sell that asset after 5 years, or either before 5 years. Okay, so sale during useful life, it means in the given example you decided to sell the asset before 5 years. Okay, so cost of asset 10,000 and accumulated depreciation is 6,000. It means what is the book value? What is a book value means it is also a carrying value in your books. So it means 4,000 because cost of the asset is equal to the purchase price. Cost of the asset is also known as a purchase price. It means how much price you have paid to acquire that asset, 10,000. And at this point of time, how much depreciation you have charged? 6,000, right? So what is the carrying value or book value in our books? 4,000, right? And sale price 5,500. It means in the market you are able to sell that asset at 5,500. So how much profit you have generated? 1,500, because in the books of accounts you have the carrying value of that particular asset is 4,000, but in the market you are able to sell at 5,500. Okay, so what is the journal entry that you pass whenever you are selling the asset? It means that asset is going out from the business. Okay, and it is a real account, so whatever is going out from the business you should be credited it. So asset account should be credited. Accumulated depreciation we need to debit, right, because it is a provision account, so we have to debit it. So that's after that we can say that the asset value will be 4,000, right? And sale price is 5,500. It means you have received the cash or debtor balance 5,500, and rest, that gain is a notional account, and as per the notional account it should be credited whatever the income or revenue we have, so 1,500. Okay, and if in that case we are able to sell the asset at 3,000, so it means 1,000 is a loss for us, and that loss we should be debited. Okay, sale at the end of the useful life, cost of the asset similar 10,000 and accumulated depreciation is 10,000. It means, so this is an example of at the end of the useful life. It means after 5 years you want to sell the asset. Okay, so cost of the asset and accumulated depreciation is equal here, so it means carrying value will be 0, book value is 0 in your books of accounts. It means whatever the value you will be able to recover through sale, it is your gain only. So cost of asset you will be credited it, accumulated depreciation is debited because it is a liability account, so reduce the liability, you will have to debit it. Okay, and the scrap value you are able to receive the cash by 10,000, and 10,000 is your gain, so you will have to credit it. Okay, so here is a journal entry where you will be able to understand what are the journal entries that you have to post. But whenever you are able, whenever it is a profit in the books, you have to credit that profit, and whenever there is a loss, you have to debit that loss. And whenever there is a sale happen, it means asset is going out from your business, so that asset account you should be credited it. But on the asset we have two methods. Either we will charge the depreciation directly into the asset account and reduce the value of the asset. Okay, so in that case there will be no accumulated depreciation account we have. But second approach is, either we will maintain a separate accumulated depreciation account where we will recognize the entire cost of depreciation, and it means the cost of the asset, the asset account will be at a purchase price, right? So in that case, the asset account we have to credit it, and accumulated depreciation account we have to debit it to arrive at the book value or a carrying value of the asset, or we can say that the net value of the asset, right? And that book value or the net value or the carrying value you have to compare with the sale price, so that you can so that you are able to evaluate how much profit or how much gain you have through that particular sale transaction. Okay, let's understand with some examples. First case study: machinery cost 1,20,000, useful life is 10 years, depreciation is SLM method, straight lining method you have to follow. It means 12,000 depreciation you will be charged every year, right? After 4 years, it means after 4 years, it means you already charged 12,000 each year in, so it means 48,000 you already charged. And what they want to now, 25% of the asset capacity they want to sold. It means 20% of the portion they just want to sold, not entire portion. Okay, so first of all you need to arrive the book value, right? After 4 year, what is the carrying value or what is the book value in our books. Okay, so first of all we need to compute the annual depreciation, and we need to compute the accumulated depreciation. Okay, that is 40,000. Now they want to solve the 25% of the asset. So first of all we need to see one of the original cost, but how much 25% of the portion is 30,000, and out of the accumulated depreciation 12,000. Okay, so it means the book value of the 25% portion is 18,000, and we want to sell at a 8,000. So it means 18,000 of the machinery we can now sell at 8,000 only. So it means 10,000 is our loss. Okay, so what will be the general entry that you will post? Asset account debit 30,000, accumulated depreciation account by 12,000, bank value 8,000, and rest 10,000 is our loss account. Second case studies: cost 9 lakhs, original useful life 9 years. It means 1 lakh you will be charged every year. After 3 years, it means after 3 years, it means what is your book value in your account? 6 lakhs. The useful life revised to 3 years. It means original life is 9 years. So it means after 3 years the remaining original useful life is 6 years. But after 3 years they have evaluated the useful life is only 3 years, not 6 years. It means 6 lakhs cost you have to charge in 3 years only. So it means 2 lakhs every year you have to charge now. After 2 years the asset is sold. It means after 5 years they want to sell the asset, right? So after 3 years the asset value is 6 lakh, but after at the end of the 3 years they have evaluated that asset life will be 3 years only, so the depreciation rate will be changed, and annual depreciation is 2 lakhs, right? So after 2 more years, what is the book value? So out of the 6 lakhs, 4 lakh is gone as a depreciation, so it means asset value is 2 lakh only, and now we are able to sell the asset at 2 lakh 40,000. It means gain is 40,000. Okay, so in that case asset account debit by 9 lakh, accumulated depreciation 7 lakh, because in first 3 years we have charged the depreciation of 3 lakhs, and another 2 years we have charged the depreciation of 4 lakhs. It means 7 lakh total we have charged, and bank account debit by 2 lakh 40,000, and rest is our gain as a 40,000. Okay, hope you are able to understand the concept. In the sale, you just first of all you need to, the basic is you need to arrive the book value, and that book value you have to compare with the sale value, so that you are able to evaluate how much profit you have generated or how much loss you have occurred. Okay, and after that accordingly you have to pass a journal entry. If it is a gain you have to credit it, if it is a loss you have to debit it, and asset account always need to be credited it, and if there is a accumulated depreciation we have maintained separately, that you have to debit it, because sometime to charge the depreciation we have maintained a separate account. in that way we never charge the impact of the depreciation in the asset cost directly. Okay, so try more and more examples, then you are able to have understanding, or have able to increase your understanding. Okay. Okay, have a good evening everyone. Thanks, bye.